Canadian public pensions garner high praise by international standards, setting a stable path for the funds and the retirees who rely on them. That's great as far as it goes, but it doesn't tell the whole story of how well Canadians overall are set up for creating secure retirement incomes. Joining us now for a fuller sense of that, Hugh O'Reilly. He is president and CEO of OP Trust, one of Canada's leading defined benefit pension plans. Marlene Puffer, partner at Alignvest Investment Management and a board trustee at the Healthcare of Ontario Pension Plan. That's HOOP for short. Keith Ombrasher, Director Emeritus of the International Centre for Pension Management at the Rotman School of Management at U of T. He's also president of KPA Advisory Services. And Caroline Cakebread, Editor, Canadian Investment Review, and a financial literacy expert. And we're delighted to welcome all of you to TVO tonight. Hugh, for the first time in 20 years.
That's right.
It's really 20 years since you were last here.
Yep.
My goodness. That's no indication that we thought you were lousy last time, just so you know. That's not why it took 20 years.
I'm a generational phenomenon.
There you go. There you go. And Keith, you've been here before, although, again, many years ago. So
it's been a while.
Good to see you, too. Let's put this up, shall we, Sheldon? This is essentially the retirement picture for Canadians from coast to coast to coast who have retirement savings. You know, 65% of us apparently have retirement savings, and let's break this down. 30% have a registered pension plan. That is a plan at work or through a union. It's either a defined benefit or a defined contribution plan. Those are different. We can get into that. 35% have some money socked away in a retirement savings plan, an RRSP. 40% have money socked away in a tax-free savings account, a TFSA. And 35% have little to nothing saved on their own. Now, of course, when they turn 65, they'll get old age security and they'll be eligible for Canada Pension Plan. I'm not there yet, but people tell me that's not enough to live on, and that's why you got to start doing your own thing. So, with those numbers in place, Marlene, get us started here. What jumps out at you as something we have to pay attention to?
Well, I think we really have to pay attention to those numbers at the bottom of that list, that the numbers for people who are in the lower income brackets are going to be struggling through their retirement. We cover off the very, very basics with old age security and the Canada Pension Plan. And you're right, it really is not enough to live on. And then when you go up the ladder a little bit, where people are actually saving, I think one of the key things is that they're saving in a way that they're losing out on potential returns. So they're not investing in the best way possible necessarily. They are investing in kind of an old-fashioned way. They're investing in a way that is not going to give the returns going forward that they've gotten in the past from a standard kind of 60% stocks and 40% bonds kind of rule of thumb.
Mm-hmm.
That's done fine over the past 20 years, but with interest rates at 2 or 2.5%, the stock market expected returns maybe 5 and change, you're not going to be earning enough within a portfolio like that.
We need a new way of doing business.
That's right.
Okay.
I think what those numbers tell us is the story for the next 20 years is that we have a retirement income crisis in Canada. We need to address it. We need to address it now. There's fears that people have about intergenerational equity, the bills that the millennials are going to get stuck with. But I'll tell you what, if we don't start dealing with this issue now, the bills that they're going to get stuck with 20, 30 years down the line are going to be unbelievable, because we're not a society that's going to let old people live in poverty. And if it's one of those, it's like the old Fram air filter. We either pay it now or pay it later. And I think we have to get on this issue now.
Caroline.
Yeah, I was going to add to that by saying, you know, there's a lot of different ways that people are saving and a lot of ways they should be saving, whether it's 60-40 or some of those tools that Marlene alluded to. But at the same time, when you look at the big number that the median retirement savings of the average Canadian of the age between 55 to 64 is actually just $3,000. So even
That's the median?
Yeah.
Amount of savings per year?
Yeah, in total. In total is $3,000 according to the Broadbent Institute. And beyond that, even for individuals who are earning between $50,000 and $100,000 a year, you can kick that up to $21,000 as their total retirement savings that they have in the bank between the ages of 55 and 64. So we're just getting up to retirement. So out of the gate, we have a problem that isn't looming 20 years down the road. It's actually around the corner. And I find it interesting that there is a spectrum of savings vehicles out there, but I really question how much people are actually socking away in those vehicles.
Keith.
Not as bad as what I'm hearing. Number one, Canada actually ranks highest in the world in terms of income replacement for low-income workers. In fact, in many cases, they get more in retirement than they did when they were working. So immediately the issue for Canada, other than just raising incomes generally, the low end of the spectrum, actually we're doing very well on a relative basis. So if you move up the income ladder and you do the middle income group, immediately you have a huge split between people that have workplace pensions and those that don't. And in the broad public sector, these pensions do exist. So again, there's no issue there. It's going to be significant income replacement on top of OAS and CPP. So that's not an issue. So now we're getting down to the group that I think we need to look at most carefully, which are middle income workers without pension plans that would like to maintain their standard of living after they stop working. And so that's a very specific group rather than some broad general problem.
I'm going to go back to Hugh right now because on the one hand, you say we're doing better than is being suggested out here, and I hear you saying we're in a crisis. So which is it?
I think it is a crisis. A few things I'd point out. First of all, when we look at history and we talk about the position of seniors, that's in a period of time where we had fewer seniors than are about to retire. The leading edge of the baby boom is coming. The pressure that's going to put on government from a fiscal perspective, OAS, GIS, those supports, plus healthcare costs, this is a big burden. I think, and we also have to be aware of the fact that we've had, Steve, you hail from Hamilton, we've seen the demise of industry, we've seen the demise of defined benefit plans. What's coming is different than what has been. We can try and isolate it down to the middle class, but I think it's more than that. And I think that the other issue we have is we have to keep this issue front of mind. We have to continue to promote these, whether it's financial literacy, whether it's individual savings, or whether it's expanding pension plans to meet the needs. And then when you add in what Marlene was talking about, where the yields aren't there for people to retire on, they're going to take more risk with their investments. We've got big problems coming.
But
Hang on, let's do the math again, very simple math. Let's talk about folks in today's numbers. OAS, about $7,000 a year. If you look at the expanded CPP benefits, it's going to take a few decades for them to roll in. Yeah. But essentially now you're going to be able, where we're targeting is to replace 1/3 of earned income up to a maximum in today's dollars, about $65,000. So that's roughly $20,000. $20,000 plus $7,000, $27,000. If you now have a two-income family, we're now up to $54,000. I'm sorry, but I don't see where this crisis is coming from. There are pockets where we need to do things, but we don't have a retirement income crisis in
Marlene,
Canada.
let me get you on that. You haven't weighed in on the crisis aspect of it yet.
Well, I think Keith there's some validity to what Keith is saying, that at the lower end there is a combination, but I think a lot of that is premised upon people being in couples. And I'm sorry, but the family structure has broken down, and there's a whole lot of people living in retirement not in a couple situation. So I think that's not a fair comment. And the vast majority of retirees who are in the older age range are female. So female poverty is a reality. And if all you're living on is that $21,000 or $25,000 or whatever it is that you get in that combination, you may not be eating cat food, but you're certainly not able to afford supported living if you need that.
Isn't the assumption that your kids are going to take care of you as well?
Well,
assuming you've got kids, of
sure,
course.
but I'm sorry, but my kids are looking at trying to live their lives, and it's a heck of a lot harder for them to do the things that we did in our generation, saving for any kind of house purchase and paying for their education. My kids are privileged. They're getting their education paid for, but not everybody does.
Caroline.
I just want to pick up on that point. I also think it is particularly difficult for women and, individuals who have come in and out of the workforce. Perhaps they have the burden of caregiving at home. Perhaps they have not been in the workforce consistently through time. And in addition, women live longer than men. 2 to 3 years longer than men. They have to save more, and they have more barriers and challenges to saving, given their role as a caregiver, often in the home, and given the fact that a high percentage of senior women are living alone and not within an economic family.
And more are self-employed. So they don't have the luxury of CPP, and even if they are working and self-employed, and then we've got the tax structure that's shifted now that's made it even more difficult to take advantage of what used to be, facilitated saving through your personal corporation.
Keith, we heard some kind of shocking numbers here from Caroline a moment ago. Can you, which clearly you don't think is what people ought to be doing. That's what they are doing. In your judgment, how much money should people, not are they, but should people be putting aside every month, every year, whatever, to account for their retirement years?
Right, so you start at the end. The end is to maintain your standard of living, right? That's what we'd like to be able to do after we stop working.
Right.
And then the question is, well, what's that amount? And there are actually some very interesting calculations. Broadly, we used to say it's 70% of your final earnings. That's the number to maintain your standard of living. Well, there's now more detailed research on that. Bonnie Jean McDonald, for example, at Dalhousie has done a fair amount of work, that in fact, depending on your circumstances, that number might be anywhere between, at the low income at 100, you need 100% income replacement or more. But once you go up the scale, if people have got their house, the kids are gone, then it's more like 50%, not 70%.
Okay, so to get 50% of, say, your, close to your last salary or 3/4 of your best salary, what are you looking at?
So, well, let's pick a number, $80,000 a year, 50% is $40,000 a year. You've got 2/3 of that coming from OAS and CPP, and you're now down to a manageable number. Now, I do agree that many cases haven't done that math, and they haven't said, "Oh my gosh, I have to save 5, 6, 7% per year to get that additional income," and that's a problem. I agree that's a problem.
But not as a percentage. So give me a real number. That means every paycheck I have to put aside what?
80,000. Let's do a high number. I think is 10% of pay. So that's 10% of 80,000 is 8,000. $8,000 a year. Yeah.
$8,000 a year after taxes?
Oh well, that's before tax because it's tax deferred, right?
Yeah.
Okay.
Yeah.
But then what we're leaving out is when you put the $8,000 a month, if you're investing that money on your own, that's hard to do. And it's hard to do for a bunch of reasons. Investing is not simple. It's a difficult act. Second, it used to be a time where bonds would earn you, say, 4, 5, 6%. That doesn't happen
Those days are
anymore.
gone, yeah.
So now what's happening, in order to get to the right number, people are chasing returns. And as you chase returns, there's potential you will go into riskier assets. That all works until it doesn't. Because the realities of financial markets are cruel. And when those slide off the table, they will, and we're going to have other issues there. I think we have a lot to consider. I think we have to view this not just in terms of a point in time right now. We have to view this from a point of sustainability, what makes sense and what's fair overall. And getting the right mechanisms established now to avoid problems, I think makes sense.
Marlene.
So I think Hugh's points are accurate in terms of the difficulty of investing on your own, but there's a lot of innovation in the marketplace since the last decade or so.
Meaning what?
So, among other things, there are simple platforms that millennials are enjoying that are robo-advisor kind of investment platforms. So you can have, it's not cheap, but it's cheaper than investing in an old-fashioned mutual fund where we have the highest fees on mutual funds in the world at 2+% a year. That's off the top when all you're going to be expecting to earn is maybe 6% if you're lucky. So mutual funds are just a terrible instrument for individual investors, but there are alternatives today. So among them are things like the robo-advisors, where it may be 0.5% plus a little bit of embedded fees on exchange-traded funds underneath. You get a very well-diversified portfolio that's not just Canadian stocks and Canadian bonds anymore, that gives you access to some global markets. Then there's other layers. So at my firm at AlignVest, we have developed an investment fund that allows individuals to access the same sophisticated kinds of investments that the pension plans make. So Hugh mentioned that he thought you have to go into riskier investments. You don't necessarily, because there's the free lunch in investing that is called diversification. And the vast majority of individual investors are very under-diversified. And with the kinds of instruments and the fund that we have created, this has allowed individuals to access the strategic things that pension plans do that are getting out of fixed income and into other asset classes, alternative asset classes that have low correlation to the stock market. So you get protection from the downside, and the whole portfolio is actually not riskier when you put it all together.
I think in individual terms, that's great. And I think it's really important to have access to investments like that. But I think for the layperson or the individual, even getting out of the gate and making a plan to save and understanding, how much they have to save and how much they should be allocating out of their paycheck, even whether it's before or after taxes taken off, is a huge hurdle. And I think we're not there yet. And millennials themselves are among the most risk-averse investors in history. They lived through the financial crisis. They're highly mistrustful
They have no job
of
security.
markets. They have no job security. And I think those are realities we really have to deal with. And even among seniors today, seniors now are accumulating debt at record levels. Keith, you mentioned, seniors being able to kind of tally up all their savings in their home and all the additional assets that they had. But, at the same time, they're often carrying a mortgage well into retirement or a second mortgage or trying to help their kids. I mean, there are a lot of issues here that I think need to be addressed and are contributing to a crisis.
So when I look at this stuff internationally, and you look at the countries where that's not an issue, the kind of stuff that we're describing, and it's countries where participation in a workplace pension plan is compulsory. Mm-hmm. Australia does it. Most of Northern European countries do it. Mm-hmm. So if that additional piece that we're talking about, if it's just part of your employer must offer this to you, then we're in a different ballgame. We're no longer talking about, oh my gosh, how do we get people to actually do this? To the more, I think, creative part, which is given that people and their employers have to do this, what should the design look like?
And we don't have that here, though.
We don't have that
we have it
beyond.
here?
Well, we have it up to a point with the increase in the Canada Pension Plan. But again, arguably for middle-income workers, we just did some simple arithmetic to say it's not enough for most people in terms of maintaining their standard of living.
But
Just to be clear, hang on, just to be clear for a second, and if you're in the public sector, chances are you got a pension in this province.
Yeah, you're fine.
Correct.
If you're in the private sector, chances are increasingly you won't going forward, right?
Or you may not have an adequate one.
You may not have an adequate one.
Right.
So do we need a new legal framework in this province that says everybody who's got a job in this province has to be in a pension plan?
Well, we were on our way to doing that with the ORPP, the Ontario Retirement. Remember that?
Well,
and it got dropped as soon as there was the national deal on expanding the CPP. I think we should revisit the concept and think about. And the other part that I keep pounding the table on is, where is the commercial private sector? Marlene talks about her firm doing some things, but where are the big broad reach insurance companies? Sun Life, Manulife. They have all the wherewithal to create the kind of plan that we're talking about, and they're not doing it.
because?
Because they're focused
why
on
don't
the
you say
defined
it?
contribution platform more than anything else, I would say.
Well,
And
I think
Okay,
the other thing.
here's a good point. Hang on, just before you go any further, because we're into jargon here that not everybody's going to understand. Basically, two different kinds of pensions, right? Defined benefit, defined contribution. Marlene,
so
go.
defined contribution plans are those where the employee and the employer will contribute, usually an equal amount, into a fund, and whatever that fund's investments grow to at the date of retirement becomes the pot that's available for retirement. So there's a lot of uncertainty in what the investment structure is, and in fact, the individuals get to choose what their investment structure is, and it's not necessarily decision-making that's in their best hands, as people don't necessarily choose an asset mix that's going to meet their needs.
High risk, high reward, potentially.
Potentially, and also they don't necessarily have access to the more sophisticated kinds of investment strategies. It's usually pretty plain vanilla, and they're stuck with this 60% equities, 40% bonds kind of idea that's not going to perform
Compare
well.
that to DB.
Defined benefit. So the bulk of the public pension plans and a number of private plans are defined benefit. So you put the money in the pot, and the pot grows over time, but the responsibility for paying the amount that has been promised via the pension. So a percentage, usually a percentage of the last 5 years of income or the last 3 years of income. There's a target percentage. That's the pension promise. And that pension promise must be met by the pension
It
plan.
is guaranteed.
Yes.
Well,
until
whoa, hang on.
it's not.
Okay, all right.
No, it's
So-
not.
People are better off.
Okay, hang on.
But that's the promise that the pension organization is obliged to meet. Are there risks around it? Yes.
But nothing's risk-free.
Because if your company goes out of business,
but
nice talking to
A
you.
couple things, but when we talk about DB and DC, I think what's really important is when you look at some of the research that's done, this is not an academic conversation. People who retire on defined contribution plans worry about outliving their money. They make decisions to preserve their capital. What it means is, and the research that, for example, I believe that Hoop has done, shows that those people don't eat well. They sometimes scrimp on things like prescriptions. They don't live their dream of traveling. None of that happens. You look out on a defined benefit side, those people understand what they're getting every month. Because of that, they make plans. They don't worry about outliving their money.
We're all
Longevity-
agreed here the defined benefit is a better way to go.
Yes.
But again,
Yes.
you have to take the spectrum. The only people with pure defined benefit plans in this country are federal civil servants. They have an absolute guarantee that, according to some formula, that's what they're going to get paid.
That's
Inflation
true.
index.
Because the
What's
government of
happening?
Canada isn't
That's
going
not
out of
true.
business.
That's not true.
There are other ones, but most
example, the
plans,
members of my plan.
And the members of
most
who?
public service plans are starting to go towards target benefit, where there are
No.
there are contingencies under which you don't get the full benefit.
That's
Inflation indexation is becoming ad hoc.
not in my
Ontario
plan.
Teachers has had it for 10 years. So we're going away from the pure defined benefit towards various kinds of risk-sharing arrangements that make more sense and are more sustainable. But we have to put that on the table. There is no such thing anymore as, the bookends of DB and DC. We're moving towards the middle. If you go back to Australia, you now have DC plans where people have been in a DC plan for 30 years. They now have accumulated capital values of $300,000, $400,000, $500,000. Guess what the conversation is in Australia? How do we build income for life back ends onto our accumulation plans? So the whole thing is converging towards something that's halfway between DB and DC from a design point of view.
Quite right. No. So
Well, I'm sorry, but I've looked at the whole world,
Well,
and I've been in these countries, and I've seen it happen.
But we're talking about
there
Canada
are
at the moment.
there are different approaches that have been adopted, and I think that's one of the great things about pensions as a rule. Pensions in Toronto, some people call Toronto the Silicon Valley of the pension world. There's different ways of doing things, different experiments. But at the end of the day, a defined benefit pension plan where you know what you're going to get is the common model in the public sector in Ontario. There is risk sharing, sharing of deficits, sharing of surpluses, how they're used. But the reality is professionally run plans that pay attention and focus on what the member interest is.
Okay, I hear you, but let me do a
succeed.
follow-up. Hang on a second. Let me do a follow-up question here. Who knew pensions can be such an intense topic for debate here?
Absolutely.
Okay, but here's the thing. And I
Nerds
remember,
have passions too.
I remember when the former Conservative Party of Ontario leader Tim Hudak raised this. He said, it's all well and good for some lucky people to have defined benefit plans, particularly if they're public servants, funded by the contributions of people in the private sector who don't have those kinds of good pensions and may have DC pensions, may have no pensions at all, and they're funding these Cadillac pensions for public servants. How much pension envy is out there is my question.
Well, based on research we've done, in Ontario, there isn't pension envy anymore. What people understand now, this is the research we've done about a year ago, what people in Ontario, they believe that it's fair that public servants have these pension plans, and what they want.
Really?
Yes.
That is not what my...
Yes,
Can I say
no,
something?
Keith, we've done the research.
That
We've
is-
done the research.
But
We have the,
you
let me
have to-
finish, can I finish,
you
Keith?
have to-
Can
okay,
I
let me
finish?
finish.
Do you
Hang on.
mind if I finish?
Yeah,
Is it all right?
Finish, and then we'll get Keith to come back.
The point is, and I think this is the critical point in where we've evolved to as a society, pension envy has disappeared in the sense of people begrudging public servants a pension. What they want is retirement income security for themselves, and we've seen that. They supported Kathleen Wynne and voted for her on ORPP, which was a major plank. Kathleen Wynne's efforts, the efforts of the Canadian Labour Congress, led to an expansion of the CPP, which would have been unthinkable.
So we don't mind if you have it as long as we get it too.
They want
That's
something,
the thinking.
yes.
Okay, Keith, and then Caroline.
So part of this whole process is understanding the cost of these arrangements. You know, it's fine to say, oh, this is nice to have this. One of the things that's gone wrong on the accounting side is we haven't been properly valuing the cost of these guaranteed promises.
That's not, you know,
That's
again,
not an issue?
That's not an accurate statement. What you're doing is you're taking an academic's view, and there's different ways of looking at this. No, there's the reality of funding these plans. There's the fiduciary obligation to invest in assets that are going to earn returns over time and establish a discount rate, as opposed to going off the real
You're
bond rate.
describing a target benefit plan,
No,
which
I'm
is
not
perfectly
describing
fine.
a target benefit plan.
Caroline, come on in here.
Okay, I want to go back to your point about pension envy. And while I understand that some surveys have shown that it doesn't exist, and I take that point, I think there's a great deal of room for pension envy to emerge as a huge issue, given that you know, a small percentage of Canadians have access to a DB plan at all. Many Canadians don't even know whether they have a DC or a DB plan or what they've got. And 1 in 3 Canadians don't feel completely unprepared and stressed out about their retirement income security.
So this speaks to financial literacy.
It does. It speaks to financial literacy and a basic fundamental understanding of what's being spoken about here by the panelists, which are many of the real issues. I think for the individual, it kind of boils down to, I'm really worried, I don't have enough, I'm humping this huge mortgage that I'm hauling around, I have a lot of debt, I don't know where my retirement income is going to come from. And wow, my government, my neighbor that works for the government, you know, isn't worried about that and is buying a cottage because they have a pension plan and they're not worried.
Well, they may not be buying a cottage, but they are able to spend their pension in the community and help to support the economy that they live in. So there are very positive externalities from having this kind of DB pension plan. For example, the 330,000 healthcare workers of the province. The research that HOOP has done has shown that there's a substantial impact on a number of communities in Ontario that is very positive, and it means that those people who are in retirement and drawing on this pension are not dependent on social assistance, and they're not.
They're contributing to the economy.
They're contributing back to the economy.
Steve,
So when you add it all up,
I also think pension funds, like ours, like HOOP's, we have an obligation of what I call pension citizenship. So not only do we have to advocate for the defined benefit plan, and our members advocate for it, we also have to think of creative ways where perhaps coverage under our plan can be expanded, where our investment offerings can be offered to smaller plans so that we can help. Because we don't believe in a situation where we're going to be the last person standing. So we think this concept of pension citizenship matters. And I think it's something that we want to do more than talk about these issues. We want to act on them and help contribute to the solutions to this problem.
Is one of the solutions, and Keith, I'll just put the platform towards you. Tim Hudak, when he was running for the election, this is the last election, said, we can't, as a province, afford to give everybody a defined benefit pension anymore. Right. So new public servants who get hired after we form the government, they're only going to get defined contribution plans. Is that an appropriate approach?
What we're doing here is we're convoluting two separate things. I totally agree with Hugh that the fact that we in Canada have created infrastructure in terms of the kind of organizations that manage pension arrangements are the best in the world. Now, there's something called the Canada model.
and among the most cost efficient.
And most of the cost effective as well. So, but that's regardless of what the formula is for the pension. That's true regardless. The question of how and under what circumstances, who bears what risk, what the size of the pension is a separate discussion. So, and again, if you take $100,000, just to make it easy, right? I can do one of two things with my $100,000. I can spend it all, or I can save 25% of it and put it in. If I do that, I will have a great pension. Mm-hmm. And in a lot of cases, that's what's happening with public sector, is that their significant pieces are being scraped off the total compensation and put into a pension plan. There's nothing wrong with that.
Can I just understand this, though? In order to save money going forward, would it be a good idea that any public servants, and I'm talking about teachers, I'm talking about, I mean, everybody, anybody paid by the broader public sector, going forward, no more Cadillac pension plans, only the Chevy pension plans.
But again, let's take the current teachers happen to know the numbers. It's 12% and 12%. There's 24% of pay going into those pension plans. And my point simply is, if you put in 24% of pay into a pension plan and you manage it properly over time,
You're gonna be fine
you're going to have a
regardless.
ton of money.
Okay,
I'll
Hugh.
answer the
Right?
question
Yeah.
about. I think that what happened to Mr. Hudak's party in the 2014 election bears out the point I was making. Never caught fire. People didn't act on their pension envy to vote out Kathleen Wynne. And when you cost out these issues from the point of view of defined contribution plans, whether it would save the government money, it doesn't. The only province in Confederation that has a defined contribution plan for its civil servants, the province I grew up in, Saskatchewan, they set that up in 1978. They never set it up to be cheaper. The contributions into that plan in some areas are 9, 10, 11, 12% of pay and matched. The issue is not pensions being expensive. Retirement's expensive. You're going to live a long time without bringing in money. That's why we have to deal with this issue.
Well, and the other issue
Yeah,
is
but-
getting
but
the
see-
investment strategy right. That if you don't get that right, you're leaving a ton of money on the table and putting that pension at risk. And then the question becomes, who bears that risk? So the DC plan, the individual bears the risk, and in the DB plan, the risk is the responsibility of
Marlene,
either
even the bigger thing is that 2% haircut that gets taken out of retail mutual fund approach to our RSPs. If you compound, you don't have that 2% per year for 40 years, costs you half your pension. So the other huge problem we've got is the infrastructure in this country through which people have opportunities to save for retirement.
Well, in
We
which
have-
case, Caroline, do we need to have more room in RSPs to give people more room to save?
I think we need to look at the entire spectrum of savings vehicles and not just, make it a one-shot policy decision based on whatever government's in power. It's patchwork. I think the opportunity, and Keith, you alluded this and you alluded to this as well, Hugh, is to take best practices from our world-leading public pension plans that are, that have a small membership relative to the Canadian population, and come up with ideas and bigger picture tools for individual Canadian savers to be part of a pension.
Yeah, there are also tools that people don't have any awareness of. So
Such
there's
as?
something called the individual pension plan. So for business owners who are self-employed, the individual pension plan is a fantastic tool, but it's full of cumbersome layers that have made it difficult for people to implement. Only 11 or 12,000 of these individual pension plans have been started. They're a fantastic saving vehicle. They allow individuals who are self-employed to save at a higher rate than through their RSP to accumulate more retirement assets, and yet they need an actuary, they need a money manager, and they're challenging to set up.
Caroline, I got 20 seconds left for my financial literacy expert here. We need to start talking to elementary school kids about pensions, don't we?
We do, and that is underway. There is sort of officially financial literacy in the classroom. Whether or not it's being done well or effectively is up for debate, and I'm sure there are a lot of people who are doing a great job, but I think we need to do more. But I do think it has to be throughout the lifespan. I mean, how do you come up with pension savings discussions in a grade 3 or 4 or 5 class, right? This is something that has to be done throughout the life cycle of a person. And at the moments when they need this information, whether it's when they first sign up with an employer and maybe have access to a savings vehicle, when they buy their first car, when they buy their first home. These are the points within life where you're looking for this information.
Gotcha. That's our time, friends. Hugh, see you in 20 years?
Yeah, sounds good.
That's a deal. Can I thank Hugh O'Reilly, the President CEO of OP Trust, and Caroline Cakebread, the independent financial literacy consultant, also the editor of Canadian Investment Review, on one side of the table, and Marlene Puffer, the partner at AlignVest Investment Management. She's also a trustee with Hoop, and Keith Ombachir, Rotman International Center for Pension Management at U of T. Great to have all of you on TVO tonight. Thanks so much.
Thank you very much.
Thank you.
The Agenda with Steve Bacon is brought to you by the Chartered Professional Accountants of Ontario, helping businesses stay on the right side of change with strategic thinking, insightful decisions, and business leadership. Are you on the right side of change? Ask an Ontario CPA.